Hello everyone, I hope you guys are all doing well. I've had a lot of questions recently on how our investment tax, whether or not you should pay taxes. I'm going to dedicate this whole video on capital gain, gain and losses, and how they're taxed. So the way I'm going to explain it is, I'm going to break it down into 5 different categories, 5 different segments. Some of them will correlate with one another, some of them will flow from one to another. I'm gonna try to explain it as smoothly as I can, but it's a hard subject to wrap your mind around. There's so many different factors, so I'm gonna try my best. Okay. So the 5 that we're gonna talk about is gonna be types of investments. We're not talking about, in this case, we're not talking about real estate. Okay, buying or selling a house, a boat. We're just talking about stocks, options, and dividends. Those 3: long-term, short-term. How long do you hold it for? Gains and losses, we're going to talk about how do you treat gains, how are gains treated, and how are losses treated. Tax bracket, we're going to talk about where you can find your tax bracket, what are tax brackets, and how do you determine what your tax bracket is. And finally, we're going to talk about wash. I'll explain that when we get to it. So we'll talk about types first. The best way to explain, to break this down, is stocks. We have stocks and we have options. In this video, I'm not going to explain what options are, okay? Options are calls and puts. Maybe I'll make a video in the future explaining it. But stocks and options, I want to group them together and I'll explain why. And then I want dividends to be over here by themselves. So that's dividend. The reason why I want stocks and options to be together is because they're taxed in the same way. And how are they taxed? We're going to so these are the 3 types we're going to talk about. We're going to talk about long-term, short-term now. Dividends are always taxed at long-term. Okay, keep that in mind. Stocks and options, they're treated the same way as far as how they get taxed, but they're taxed in 2 different ways. They're either taxed at short-term or long-term. And how do you determine whether they're short-term or long-term? If you hold it for less than 1 year, that's considered short-term, okay? So by default, if you hold it for more than 1 year, that's considered short-term. Next, we're going to move to gains, okay? So let's consider this as a gain. What is the difference between the tax rate? For long-term, you're looking at 2 different tax rates, okay? You're looking at, where's that blue? You're looking at a 15% and you're looking at a 20%. So these are the 2 tax rates you can get taxed at when you hold something for long term. And why do they have 2 different tax rates? It's based on your taxable income. So over here, if you make more, this is 2017, if you make more than $418,400 for 2017, your long term will be taxed at 20%. Your long-term gain, and 15% is going to be just the opposite. If you make less than 480,000 taxable income, you're going to get taxed at 15%. Now for short terms over here, how do short terms get taxed? Short-term gain gets taxed. We're going to call this your own bracket, okay? YOB, and I'll talk about this later. So short terms will get taxed at your own bracket. Long terms is always flat 15% or 20%. And how do you determine whether it's long term or short term? Less than 1 year. Short term, your own bracket. More than a year, it's going to be long term. Or if it's dividends is always treated as long term. Let's say you buy Target back in last June. You held it for 3 months and you get some dividends in September 2016. Even though you only held it for 3 months and you got a dividend, it's still considered long term because dividends are always considered long term. Okay, so we've covered that. Now we're going to cover losses. So let's go up here. So, and the reason why short term I put in YOB is, I'm going to explain that later. Your own bracket. So I'll explain how you can find your own bracket, and once you find your own bracket, you'll be able to figure out what your tax rate is for your short-term capital gain. Okay? Now we're going to go to losses. So an example I'm going to give here is, let's say someone has a loss of $20,000 2016. So last year they got a loss of $20,000. Some people will ask me, oh, I have a loss, should I claim it at all? Yes, definitely claim it. I'm going to tell you that even though it's a loss, it sucks, but there are some benefits. 2 reasons why you should claim your losses, okay? It's going to be broken down into 2 different, your net loss for the year will be broken down to different segments. The first one, $3,000. What does that mean? You get to put that against your regular income from your W-2 if you work at just a regular 9-to-5 job. You have a W-2 and you got to enter in your adjusted income, your full income, your taxable income. You can deduct your taxable income by $3,000. You can claim $3,000 loss against it. So let's say you make $50,000. When you claim that, your taxable income drops down to $47,000. Okay, so $20,000 loss. You claim $3,000 against your taxable income for that year for 2016. What happened to the $17,000? That $17,000 is considered a carryover. Okay, so this loss will get carried over for the next year for 2017. What does that mean? If you lost 17K in 2017, let's say you gain 20K. So in 2017, if you gain 20K, you only have to pay taxes for 3K because you claim your losses rolled over. It was carried over. So you pay less taxes in the future. And let's say what happened if in 2017, that's going to be funny. That's not okay. It's 0,000. Okay, let's say you don't trade at all in 2017. How does that get treated? Your 17K, it keeps rolling over. You get that 3,000 deduction against your taxable income, and you carry over another 14,000 into 2018. So you keep carrying over and over and over until you use it all. Okay. So that's one thing I want you guys to keep in mind. Always claim your losses. It's beneficial. You're legally supposed to do it. It's illegal not to claim your gains or your losses. So make sure you claim them. If you have any question, come back to this part of the video. Otherwise, I have to clear everything out because I've covered gains and losses, long-term, short-term types. We're going to move to tax bracket, and I need a lot of space for that. So we're going to clear this up. Okay, for tax brackets, there are different brackets. How do you find the brackets? Just search them up, type in to Google 2016, 2017 tax bracket. They'll show you what the new tax brackets are. There are, generally speaking, there are 3 different types of tax brackets. Okay, there's the single tax bracket, there's the head of household, and then there's the married filing jointly, or married filing separately. So 3 different tax brackets. The one we're going to talk about, it's going to be single. Now I'm going to show you an example how the tax brackets are broken down, and then I'm going to also show you an example of an individual, how much they make and where they fall into the tax brackets, and then how you know what tax bracket you're in, so you can figure out your taxable income. So you can plan out what your short-term capital gain is going to be taxed at. Okay, I'm going to draw it out. Okay, so for the tax brackets, for single tax brackets, there are 7 different tax brackets. Okay, there's a 10%, 15%, 25%, 28, 33, 35, and 39.6%. If you make more than $418,400, your short-term capital gains will get taxed at 39.6%. And remember this number, your long-term, remember short-term, long-term. So your long-term, if you make this amount, your long-term will be 20%, and your short-term will be this percent. Okay, if your taxable income is at this level. Now I'm going to give you an example. Okay, let's say there's John, and John's taxable income is $50,000. I'm going to show you what that means, what he's taxed at, what bracket he falls under. So when we look at $15,000, okay, so when we look at if John makes $50,000, what that means is $9,325 falls under 10%, $28,625 falls under 15%, $12,050 falls under 25%, and what that adds up to is $50,000. So that's his total $50,000 in 3 different brackets. But how does it get taxed? You take this number, you multiply it by the rate, okay? 10% of 9,325, that's $932.50. 15%, 4,000, 25%, 3,000, 25% of 12,000 is 3,000. You add that up, so this is his total, this is what he got taxed, okay? Now if you take this number and you divide it by 50,000, what do you get? That's going to be 16.48%, okay? So this is also known as your effective tax rate. It's like a cumulative tax rate. It's also called an effective tax rate. Usually when you get your tax refund, this is the only number that shows up. You don't see these different brackets, okay? You only see one number. So a lot of people will get confused. They're like, oh, okay, so my tax rate is 16.48%. So if I sell my short-term gain, you buy something, you gain, let's say $5,000, you sold it within a year, and you gain $5,000, you think you're going to get taxed 16.48%. That's not what you're going to get taxed. That's your effective tax rate, okay? What you're going to get taxed is, remember that 5,000, it adds on to here. So 12,000 becomes 17,000. Your 5,000 gets taxed at whatever rate you fall under. So right now you're under the 25%. So don't get, it's slightly confusing. Maybe rewatch this portion, but that's how your taxes are broken down, okay? So even though John makes $50,000, John pays 3 different tax brackets. He pays in the 10%, 15%, and 25%. But whatever he sells as capital gain on top of that, he will have to pay 25%, or maybe it's 28%, 33%, 35, or 39, whichever bracket he falls under. But this is how you figure out what bracket you fall under. So don't look at this and say, oh, 16.48% on your number, that's what you, that's the bracket you fall under. No. The bracket you fall under is that final bracket, okay? Now this is an effective tax rate, like a cumulative tax rate. That's the average of all. That's why you take the sum, 8,238 divided by 50,000, you get 16.48%. So keep that in mind. Usually with capital gains, we pay higher than what we think we do. We always pay at the bracket we fall in, not the effective. With that being said, there's only one item left on the list that we have to look at. That's the wash. Okay, so what is the wash and how does the wash work? Okay, so what is the wash? So the IRS added a law to prevent people from washing. What is washing? Washing is when you buy or sell, let's say you buy a stock and you sell it immediately to capitalize whether your gain or your loss, or you're holding on to stock and you sell it, and then you rebuy it right away just to capitalize, just to realize your loss, to offset against another gain or loss. That's not considered realizing. And this is what I mean. Let's say John, in November, John has a gain of $100,000 November 1st, 2016. John realized his net gain for the year sitting at $100,000 for November 1st, and John doesn't want to pay taxes on $100,000. You look at his portfolio, he wants to offset his portfolio by $100,000 loss. And sometimes people with big enough portfolio can do this. What that means is, let's say they buy Apple at $100 and now it drops to $50, and their total portfolio for the portion for Apple stocks, if they sell it, they can realize $100,000 loss, and they can rebuy it immediately. So they have the same number of shares. They don't gain or lose anything, but they just realize what their gain or loss is. You cannot do that and consider it and use it to offset your gain if it's less than 31 days. Okay, so that's the rule. 31 days with the wash. If you want to wash, if you don't want it to be considered a wash, then you have to, after you sell a stock, you have to wait 31 days to rebuy the stock. Or if you buy a stock, you have to wait 31 days to sell it, whichever way. And so that's considered a wash. And that's also why, if you think about it, when is the first day you can submit your taxes? It's always January 31st of the next year. Why is it 31st? Because you have to wait 31 days. So someone can't sell something on, let's say someone sells something on December 31st. So December 31st, someone can't sell it and then file their taxes on January, let's say January 15th, and then wait till January 30th to rebuy it. Okay, so this would be sell, tax, buy. This is to prevent it. The 31 days where you file your taxes on the soonest you can file is the 31st of January. It makes this impossible. You have to wait 31 days into the next year, so you can't wash. So you can do some sort of tax planning, but remember, if you sell it at a loss to offset your gain, you have to wait 31 days. Okay. So those are the 5 segments I wanted to cover for how investments are taxed. I hope that's helpful. If you have any extra questions, if you have any more questions, just drop it down below. Other than that, if you guys want me to go into more depth with whether it's the types, dividends, stocks, options, I can do that. Long-term, short-term, I think I covered that pretty well. And remember, long-term, if you hold more than 1 year, or if it's a dividend, that's considered a long-term. Short-term, if you hold less than 1 year, it's considered short-term. And remember, short-term is taxed as YOB, your own bracket, whatever your bracket is, okay? Gain and losses, I think I covered that very well. Remember, losses over here, $3,000 against your taxable income, the rest carried over to the next year. Gains, 2 brackets, okay? Tax bracket, remember John, the example with John, even though he paid 16.48% effective tax rate, his actual tax bracket is the 25% bracket. So if he sells stocks, he pays the 25%, not his effective 16.48. Tax bracket, that was tax bracket. Wash, I think I covered that pretty well. 31 days. Okay, you can't sell a stock and rebuy it. Just realize your loss or realize your gain. And the IRS does not consider that realization of gain or loss. There needs to be a gap of 31 days before you rebuy it. So keep that in mind. I think that's about it, guys. If you have any suggestions on any future videos, please drop it down below. Any questions, drop it down below. If you found this video helpful, please smash that like button and subscribe for more video, guys. Thanks a lot.